are you interested in property investments but hesitant about dealing with the tenants, property management, or the cost of building material? Well, if that's the case, then real estate investment trusts known as REITs could be for you. So REITs offer a way to invest in property of your choice in any location and earn income without the usual hassles. So in this video, we'll explain how to invest in REITs, the different types of REITs and more. And be sure to watch until the end because I'm going to actually share with you some of the best performing REITs you can consider for your investments. So REITs or real estate investment trusts are companies that own, operate or finance income producing real estate across a range of property sectors. So what they do is that they provide investors with an opportunity to invest in real estate assets without directly owning physical property. So REITs typically generate income through rental income, property sales or mortgage interests. So the first one is through property acquisition. So REITs raise funds from investors through the sales of shares or units. So these funds are actually used to acquire a portfolio of income generating properties such as office buildings, shopping malls, apartments, hotels or industrial facilities. And the second way they operate is through income generation. So the properties owned by the REITs generate income primarily through rental payments from tenants. So some REITs may also earn income through property sales, leasing of space or mortgage interests. And another way in which they work is through distribution of income. So by law, REITs are required to distribute a significant portion of their income, which is usually around 90% to shareholders in the form of dividends. So this distribution is made quarterly or semi-annually and is a major attraction for investors seeking regular income. Another way REITs operate is they operate through management and operations. So REITs manage their operations either directly or through third-party property managers. So what they do is that they handle tenant relations, property maintenance, lease agreements, and other operational aspects to ensure that the properties generate consistent income. And another way in which REITs operate is through regulation and taxation. So REITs are subject to specific regulatory requirements and tax rules. So for instance, they must adhere to asset and income diversification rules and distribute a minimum percentage of their taxable income to shareholders to actually maintain their tax advantage status. So now that you know how REITs actually work, now let's talk about the different types of REITs that are actually available out there. So there are three main types of real estate investment trusts, each with distinctive characteristics and investment strategies. So the first type of REIT is known as an equity REIT. So equity REITs invest primarily in income-producing properties such as office buildings, shopping centers, apartments, hotels, and industrial facilities. So they generate revenue mainly through rental income from their tenants who lease spaces within their properties. Investors in equity REITs typically receive dividends derived from the rental income collected from their property holdings. Equity REITs may also benefit from potential capital appreciation of their properties over time. So Growth Point Properties Limited in South Africa is an example of an equity REIT that owns and manages a diversified portfolio of properties across various sectors. So the second type of REIT is known as mortgage REITs. So mortgage REITs invest in the real estate mortgages or provide financing for income-producing real estate by purchasing or originating mortgages and mortgage-backed securities. So they earn income primarily from the interest of these mortgages or the mortgage-backed securities. So mortgage REITs are exposed to interest rate risk as changes in interest rates can impact their profitability and dividend distribution. Unlike equity REITs, mortgage REITs do not actually own physical properties, but instead they only focus on the financing aspect of real estate. So for example, Annaly Capital Management in the United States is a well-known mortgage REIT that only invests in residential and commercial backed securities. The third type of REIT is known as a hybrid REIT. Hybrid REITs combine elements of both equity REITs and mortgage REITs. So they may own and operate properties while also investing in real estate loans or mortgage-backed securities. So hybrid REITs offer diversification across both property ownership and mortgage investments, potentially reducing risk through portfolio diversification. They generate income from both rental income and interest from mortgage investments. So for example, Atrium European Real Estate is an example of a hybrid REIT that is based in Europe. So it focuses only on resale properties while also investing in real estate loans and securities. So these type of REITs cater to different investors' preference and risk tolerance, offering opportunities for income generation, capital appreciation, or a combination of both within the real estate sector. So investors should actually consider their investment goals, their risk appetite, and market conditions when choosing amongst equity, mortgage, or hybrid REITs. So what are the advantages and disadvantages of investing in REITs? So investing in real estate investment trusts offers several advantages and disadvantages that investors should consider. So let me first break down the advantages of investing in real estate investment trusts. So number one is income generation. So REITs are required to distribute a significant portion of their income, which is usually around 90% to shareholders as form of dividends. So this makes them attractive for seeking or for income-seeking investors who desire regular and potentially high dividends. Number two is diversification. So REITs provide diversification within the real estate sector, allowing investors to spread their investment across various types of properties. So for example, residential, commercial, industrial, and geographic locations. Number three is liquidity. So REITs are traded on major stock exchanges like stocks, offering investors liquidity. So shares can be bought and sold easily, providing flexibility to access invested capital. So number four is professional management. So REITs are managed by experienced professionals or property management companies. So investors benefit from these expertise of these professionals in property acquisition, management, leasing, and maintenance. So number five is access to large-scale properties. So investing in REITs allows individuals to gain exposure to large-scale properties that may be difficult to access through direct ownership due to high cost and capital requirements. Number six is potential for capital appreciation. So REITs can offer a potential capital appreciation as property values increase over time, contributing to total return for potential investors. Advantage number seven is inflation hedge. So real estate assets, which form the basis of REITs investments, historically act as a hedge against inflation. So rental income and property values tend to rise with inflation, potentially preserving the purchasing power of invested capital. And number eight is transparency and regulation. So REITs are subject to strict regulatory requirements, including financial reporting and transparency standards. So this enhances investors' confidence and provides clarity about the financial health and performance of the REIT. Now let's look at the disadvantages of investing in REITs. So the first one is market risk. So REITs are susceptible to market fluctuations and economic cycles, which can affect property values and rental income. Economic downturns or changes in interest rates can impact the REIT's performance. Number two is interest rate sensitivity. So REITs, especially mortgage REITs, are very sensitive to changes in interest rates. So rising interest rates can increase borrowing costs and potentially reduce profitability. Disadvantage number three is dividend risk. While REITs typically offer high dividend yields, there is no guarantee that dividends will continue at the same level or grow over time. Economic conditions and property performance can affect dividend payments. Number four is management quality. So the performance of a REIT heavily depends on the quality of its management team and their strategic decision. Poor management decisions or operational inefficiencies can negatively impact their returns. Disadvantage number five is sector concentration risk. So some REITs may concentrate heavily in specific property sectors, for example, retail, hospitality, or geographic regions. Concentration risk can increase vulnerability, sector-specific downturns, or local economic conditions. Disadvantage number six is tax considerations. While REIT dividends may have favorable tax treatment, investors should consider their individual tax situation and potential tax implications of investing in REITs, unless their REIT investments are held in tax advantage accounts. Number seven is complexity of analysis. So evaluating REITs investments requires understanding of real estate markets, property valuation, lease terms, and economic factors. So this complexity may require additional research and analysis to compare to other investment options. And number eight, the last disadvantage is regulatory changes. So changes in regulatory policies or tax laws affecting REITs can impact their profitability and operational flexibility. So in conclusion, while REITs offer attractive benefits such as income generation, diversification, and liquidity, potential investors should weigh these advantages against the risk involved, including market volatility, interest rate sensitivity, and management quality to make informed investment decisions. So now let's look at the factors to consider before buying or investing in REITs. So now that you've gained a comprehensive understanding of REITs and now you're actually eager to embark your investment journey, it's crucial to actually consider certain key factors. So these factors will actually serve as indicators to help you decide whether a REIT is a good investment or a very bad decision. So they will guide your decision-making process and help you identify promising opportunities in the realm of REITs, allowing you to actually make informed financial decisions that are aligned with your investment goals. To determine whether REITs are good investments, you actually need to consider these several factors. So number one is financial performance. So look at recent financial reports to assess revenue growth, profitability, and debt levels. So analyze metrics such as funds from operations and net asset values per share to actually gauge financial health. Number two is dividend yield. So REITs typically distribute a significant portion of their income as dividends. So check the dividend yield and its consistency over time. A stable or growing dividend is often a positive sign. Number three is occupancy rate. So high occupancy rates indicate a strong demand for their properties. Vacancy rates can impact revenue and profitability directly. Number four is property portfolio. So evaluate the quality, location, and diversity of their property portfolio. A diverse portfolio across different sectors such as retail, office, industrial, and geographies can actually mitigate the risks. And number five is market conditions. So consider the current economic environment, interest rate trends, since REITs are actually sensitive to interest rate changes. Number six is management quality. So assess the track record and experience of the management team in navigating economic cycles and managing the company's assets effectively. So number seven is valuation. So compare valuation metrics like price to earning ratio, price to book ratio with other industry peers and historical averages to see if the stock is undervalued, fairly valued, or overvalued. And number eight is regulatory environment. So understand any regulatory changes or potential impacts on the REITs industry that could affect the REIT that you actually invested in. So now let's discuss the highlights of the video. I'm going to share some of the top performing REITs for your consideration if you're actually interested in investing in REITs. I've also ensured that these are available on Easy Equities, which is a platform that I frequently use for investment purposes. So I'm not going to actually get deep into details about the performance of them and all the other stuff. I'm just going to share from my research what I've seen that are the best performing REITs to actually consider. So these are the top 5 best performing REITs in South Africa in my opinion. So the first one is Growth Point Properties, the second one is Redefine Properties, the third one is Amira Properties, the fourth one is Atec Limited, and the last one is a South African Real Estate. So now you can always do your research before you invest in anything to make an informed decision. Because remember guys that I'm not a financial advisor. If you're seeking for any financial advice or a financial advisor, then please be sure to look for someone who is certified and who is registered with the FSCA. So guys, we've actually came to the end of the video, and if you like this video, please be sure to like, subscribe, and share this video to people who would actually find it very informative. So guys, I'll catch you on these other videos where I talk about the difference between a will and a trust and which one to choose. So watch this video right here guys, and I'll see you on this video.